My name is Zach Bowers. I was formerly with Rice Dairy, now known as Vault Ag. And on behalf of Vault Ag, I'd like to welcome you to today's breakout session, breaking through the noise of today's risk management tools. Mike North grew up on his family dairy farm in southeastern Wisconsin. His lifelong interest in agricultural production led him to the University of Wisconsin-Platteville, where he received a Bachelor's of Science degree in agribusiness with a minor in dairy science. While a student, Mike served a one-year term as Wisconsin State FFA officer. Mike began his work in the futures industry in 1995 as an intern with a local brokerage company, researching the technical and fundamental dynamics of commodity market history and current price trends. After nearly 2 decades in the business, Mike founded Commodity Risk Management Group in 2014. In October 2019, CRMG merged with Rice Dairy to form Vault Ag, a company that collectively provides comprehensive marketing plans, brokerage insurance, and technology services while providing high-level, unbiased research and education to its clients. With that being said, please welcome Mike North.
All right. Well, I'm happy to see we have a religious crowd. Everybody was, fighting for those back seats. Yeah, just like church. That's right. We're gonna be running through some stuff pretty hard today. It is always a pleasure to be able to get together with a lot of familiar faces. We're gonna cover a lot of ground. We're gonna run through stuff pretty hard. We're gonna save some time for questions though. So as you get them, jot them down. There are a couple pens on the table. You'll also find one of these. If we don't get your question answered, please write it down. We will get back to you on that. We also do a drawing every year too, so we throw these in a bucket and pull out a winner, and if you care to put your name down, it just could be you. So let's talk a little bit about our company real quick. We are in about 4 different states here in the Midwest, office out in California. As Zach had mentioned, we came together last fall, and if you take a look at Commodity Risk Management Group, which is my company, we joined with Rice Dairy and now basically have these different companies underneath it. So Commodity Risk Management from a branding standpoint is going to be more grain focused as we go forward. We're going to park all of our dairy efforts under the Rice Dairy name. We're going to be using the Rice Dairy Risk Services, which is our insurance agency, which sells products like DRP, LRP, and pasture and range and other things like that. Our technology company, which provides software solutions to dairymen and other producers, as well as our grain organization that offers a cash grain solution through much of the upper Midwest to producers of grain, corn, soybeans, wheat, etc. So that's a little bit about us. Let's dig right in. We're going to talk about managing risk today, and when we talk risk, it's a pretty bland word, isn't it? It encompasses a lot of territory because you have risk everywhere, right? And when we talk risk from our side of the table, we generally like to focus on markets. And so we're going to spend time today doing that, but let's just talk plainly. As we talk about market risk, that works into financial risk and some of the other things. We're going to touch on some of that too. But bottom line is we're going to spend most of our time talking about markets today and the tools that are available and how to use them and how to track them and what you need to be thinking about as you bring all of this stuff together. So let's dive right in. What is my cost of production? Why would I put that up there? Well, I'm going to be real pointed with you guys, and I know many of you in this room have done a great job of getting in front of these numbers, but as a guy that manages risk, as a guy that helps guys market their milk and buy feed and so forth, the reality is very simple, that if you don't know your cost of production, it's very difficult to be decisive about how you're going to manage a certain price. I can come to you with a great price, but if you don't know your cost of production, you don't know how great that is. How black is that number at the bottom line? I don't know. If I have no cost of production in front of me, if I don't know what my break even is, it's very difficult to answer that question, right? So in-house, we have a piece of software that we use to drill this thing down as tight as we possibly can. And yours might look a little different. I'm just going to talk a little bit about ours. Basically, we want to sit down with a guy and have this discussion very plainly. What are your costs? What are your total expenses that go into this? And, this is the high-level view. But, we want guys to be able to drill down, and we do. And you can go beyond, just this high-level view to talk about what your cost of labor is, what did your feed cost, and break that down on an ingredient basis, and talk about, what it looks like, in terms of overhead, all the way down to the smallest, most finite numbers. And then to be able to take a look at where we're at in terms of opportunity, right? And compare that to history. How does today's milk price stack up against history? What percentile am I in? This is pretty good territory, as you can see, for milk. That says something. As we talk about feed costs, it speaks to us as well, right? We can take a look at, where current prices are. We can talk a little bit about a scenario. If I want to come in here and make some changes and do some forecasting of my own, I can do the what-if scenarios and talk a little bit about, what's out in front of us. If I'm maybe a little bit more bullish than what the market is, I can build that into my what-if analysis and talk about how that plays into the bottom line. The whole goal in this is to try to get guys to think very, very methodically about what their costs are and how it lines up to the market. We're going to talk about the market quite a bit today, but reality is this is where it all starts. This is where we have to begin. Because if we don't start here, again, it's pretty tough to be able to measure opportunity. All right, let's move on. Let's talk about market risk. This is where I spend a lot of my time, right? This is where we coach people through a year. This is where we talk about, what the ups and downs are, the possibilities, the risks, the pitfalls. This is where things get real interesting. I'm gonna just kind of lay it on the line today. We're not going to talk weather. I am no weatherman. I did not bring a green screen. I am not going to talk to you about the 10-day forecast. This is not where I live. But let's talk about 2019 in terms of weather. Was it not a factor in how you ran your operation? Was it not a factor in how markets played out? Oh, absolutely. So let's just all agree that weather is going to be, again in 2020, another piece of the conversation. It will be a market influence, and that goes without saying. I think we can all agree on that, right? Okay. I am not going to talk to you about policy. Now, we had a couple of those pieces last year, right? MFP payments came out. But there's been so much talk coming out of DC, I don't even want to go there, right? I'll just let that be. We've got better people in the room. If you want to talk policy, go ask John. He's in the back right there. I am not a policy guy. We are going to talk a little bit about trade, and we are going to talk a little bit about supply and demand, and we're going to talk about how that comes together and converges in the dairy industry on the milk and feed side. So let's get right into it. Heard of this guy lately? The reality is in 2020, we are going to have ongoing geopolitical risk as we have in previous years, but maybe now heightened or taken to a new level. Things like this, and if you go back about 2.5, 3 weeks, you guys remember there was a day when everything broke hard, right? Grains were down, dairy was down, livestock was down, the stock market was down, and everything was having a bad day. President Trump, the very next Tuesday, called a press conference, right? Now, typically, he doesn't call press conferences. Usually he handles most of his needs in the social media environment, right? A few tweets and we got this problem solved, right? The reality is he called a press conference. What went through everybody's mind when that announcement came out? We are going to war. That's exactly right. And so the stock market was down 500 points that morning. We had crude oil up $3, diesel fuel up 7 cents. We had the grain market soft. We had the milk market lower. We had livestock markets down $1, $1.50. It was a bad day. 10 o'clock rolls around, press conference comes out. What does he say? We're not going to war. Okay, so what happened immediately? Stock market went from 500 points lower to 200 points higher. We saw crude oil go from $3 higher to $3 lower. Diesel fell the same, from 7 higher to 7 lower. Boom, 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 just like that. In seconds, grain markets went back higher. Milk prices recovered. Cattle and hog prices came back up. The whole world was happy again. but it changed just like that. And that's the stuff that you can't predict. That's the stuff, though, that you're going to need to be ready for. So as we talk about opportunity, and you're going through a year, and you're looking at what's out in front of you, and you feel really good about it, just know there's one of these guys lurking around the corner somewhere, and you don't know when he's going to pop his head up. This stuff is real, and it can have some real implications on markets really, really fast. So here's the 700-pound gorilla in almost every conversation we've had over the course of the last 2 to 3 months. And, if you go back to last October when, we saw President Xi and Trump get back together, they're going to have their next dinner date, right? We're going to talk a little bit about how we're going to get out of this big trade war that we've been stuck in for a year and a half. The reality was that the market started to ask the question, are we going to get a deal? Well, we finally answered that question, and it's yes, we got a deal, and they signed it last week. Now, here's the problem. We still don't know much about what the deal is, even after we signed it. Lots of things linger, right? We got, questions like what commodities are going to be favored? We still don't know. We're watching. And we have a few guesses. We think maybe livestock gets some play. We think maybe a little bit on the grain side. But, questions like, what exactly is an agriculture product? I mean, if you pressed me hard enough, I could make a case that beer and cigarettes are agricultural products. The bottom line is we still don't know, right? What's going to be included in the figures? Is this a mainland issue? Is this mainland plus Hong Kong? Well, all sorts of different things come out of this deal, but they did say above and beyond the 2017 baseline, which was $24 billion, this year they're going to add $12.5 billion to their purchases. Next year, it's going to go up to $19.5 over the baseline. That is underlying good news for us. We just don't know exactly how it's going to play out. We still don't know how, it's going to hit dairy. They still haven't pulled down all their tariffs yet. So this is not a very clear path forward. But again, as we talk about trade and as we talk about the implications to our market, we're going to keep watching this guy, right? All right. After the deal, if you look at, and this was a nice little piece that Daily Dairy put together that I think creates a great visual. This is what it's going to look like as we go through the next couple of years relative to the past. So you can see how huge of a deal this could be. But notice that none of the markets are really responding to this yet because we don't know how it all breaks down, right? Okay. So as we talk about trade in November, this is the most recent data. We'll get December's numbers as we come into the next couple of days and weeks. This is how we stack up. And when you look at Nov's numbers, 19 versus 18, you can see we had a pretty decent month. The clear winner, powder. And that market, I will tell you, is continuing to be a strong market. If you look around the world right now, those big reserves we had in Europe here a couple of years ago, gone. The shelves in Oceania, Australia, New Zealand, pretty much empty. We look at, where we're at in terms of overall inventory, we're kind of getting a little squeaky tight here too. So that price has been, relatively strong, and we'll show that in a second, but, powder exports have been really strong. Cheese had a pretty decent month year over year. And if you look elsewhere, butter, fat, and whey were a little bit off. Not surprising given what we've got going on in China. Global milk powder production growing again, right? Good markets attract what? Think about your own farm. Markets go up, do you milk less cows? No. So when prices go up in terms of powder, what do you think the world producer universe in terms of powder does in response? It raises their production. And so this doesn't really catch us off guard. We are looking as we go into the second half, and we've got a great gentleman on staff, Matt Gould, that ultimately put some forecasts together for us. This is kind of the look forward if you monitor current trends in terms of the 2020 powder production. We are looking for some increases there. We talk about butter exports. This black line right here, and you're going to see this on other slides, basically represents what the exports are. And if you look at these bars, it represents what the available supplies are to meet those exports. As we talk butter, and you look out into 2020, what you're going to realize is that we're going to carry some pretty hefty inventories on the butter category. So what does that mean? Well, it means basically we're probably expecting a little lower prices, softer prices on the butter side. Now, we live here in Wisconsin, and we'll break some of this down for you in a little bit, but we generally think of cheese, but I want you guys to think about your milk checks over the last few years and the implications that fat has had in your ultimate mailbox price. Right? If we start lowering, different components of fat pricing, that takes a little bit of the shine off of that thing. So something to keep in mind. As we talk about U.S. specifically, this is how we stack up. And you can see we're going to prolong this big inventory run for a while. Basically, if you go back to here, this is when we last had massive inventory. But we were also in that age when butter became sexy. Fat became sexy again. I mean, guys like me got a chance. Reality is, we created a new animal. The consumer demanded more butter. And with that, the prices rose, and we've been able to ride that for a long time. Our prices got so out of line over the course of the last several months with world markets, so we attracted more imports, inventories grew domestically, and so we're going to have to work through some of this in the butter space. Let's talk whey for a second. Whey, as you can see, is also well supplied and will be as we go through 2020, the way things appear right now. But I will say there's some optimism there. Right? Part of our issue with whey is that China had this thing called African swine fever. Who's heard of that? Okay, a few hands. So I want you to picture this in your mind. Picture the entire U.S. hog industry. All right? Put that in your mind's eye. August of 2018, the Chinese hog population was 5 times the U.S. hog herd. 5 times. By January of 19, so Jan of last year, they had lost about 20% of their herd. So do the math on that. Basically, they lost the equivalent of the entire U.S. pork industry, down to the last wee little piglet. Right? Gone. By April, they were down 40%. 2x the United States. Now, what do pigs consume? As they're more mature, corn and soybean meal, right? But baby pigs in China consume a lot of whey. So when we talk about whey and the impact on our country, we're going to be sitting on some inventory for a while because, frankly, we just haven't been selling them the amount that we're used to because they just don't need it. Now that's starting to pick back up again as there's signs that their hog herd is starting to expand. Cheese markets, again, as we get latter part of 2020, look to be in a pretty decent surplus. So right now, when we start looking at futures and you see $1.80 and change out there in the fall, the thing we have to keep in mind is if we're going to build inventories as we go through the year and we're going to create excess, the big question you have to ask is, can that stay? Can those $1.80, $1.90 type prices linger under this type of scenario? We're going to find out, aren't we? So, we talked a little bit about cheese price. As you look, the world prices of cheese and the United States prices of cheese have been converging a little bit, mostly because ours has been coming down, but partly because, some of the world prices have been coming up. And if you look at GDT prices yesterday, we saw just a little bit more of that. Bottom line is that we've had to move a little bit lower to become a little bit more attractive in our market. You can see we still got some work that needs to be done to make that happen. Let's talk milk price a little bit. I love this chart because it kind of gives us a look right at the heart of the question, right? And that is, what is milk price going to do and how are we going to respond to it? Well, here's the deal. Red line is cow numbers. As you can see, in the past, we have not had any significant rallies in price without a preceding culling event. Right? What have we witnessed over the course of the last year, year and a half? We've seen a fairly major, sizable culling event that now is followed by a fairly significant rally in price. And then generally what follows? Prices move the other direction, right? Again, the question I asked before, if price goes up, do we milk more cows or less cows in this country? You can see plainly the answer is we milk more cows, although I have been reminded that even when prices are low, we milk more cows too. And the reality of that is what we saw here, right? Cows numbers continued to increase even as prices were down and maybe a little bit lower. But for us, as we talk about this rebound in cow numbers and we take a look at these prices, we really start to ask some questions. Like, how long can this last? How far can we go? Will we stabilize here for a while, or will we have a correction that looks more like this? What does that look like? Nobody has a perfect answer, but when we talk about milk supply, the one thing we know is it's on the grow. The good news is that it's maybe not growing as fast as what the potential demand is. So maybe we can hold on to this for a little bit. So, I guess the bottom line is from a dairy perspective, there is still some opportunity ahead of us in 2020. I'll tell you plainly, I'm not super bearish the market, but at the same time, I'm keeping a watchful eye on this thing, knowing that at any point things could change pretty quickly. Let's talk feed for a second. For those of you guys who are looking at feed, here's a quick look at soybean meal, and it takes you all the way back here to 2005, so you get a pretty big history here of what's going on. Notice where we sit today relative to history. And we're going to use this basically as a protein index, right? When we talk about soybean meal, it's usually the benchmark off of which most of protein is priced. We've been lingering here for a while. But I want you to notice something. If you go back all these different years, there have been 2 years of late that we have not seen near $400 soybean meal. One was last year, 2019. The other one was 2017. In every year otherwise, we have seen near $400 soybean meal. So if I'm sitting wide open on the feed side and I'm saying, hey, boy, this meal price has been kind of nice, the question I'm asking myself is, will it last? Knowing what we know about, the market's ability to move and the likelihood of it going back to $400 at some point in a given calendar year, I'm sitting here looking at this saying, hey, this is a pretty good opportunity. I better pay attention. And when I talk about corn, we go back and we look at all these winter ranges and we see prices kind of bouncing back and forth. I would tell you through the course of spring, this is probably the landscape that you're dealing with. A market that's maybe a little bit sideways. However, back to our weather question from earlier, if 2020 looks at all like 2019, do you think the market's just going to take a pass in responding to weather? Probably not. So over the next several weeks, you get a chance to have some discussions about how to manage that risk. So let's talk a little bit about how we manage risk relative to milk. How do you get paid for milk? And this is always a fun question in Wisconsin because most guys, they hear and they talk about Class 3, and that's really kind of all that the discussion is. Well, we've got a lot of new tools on the table that have opened that conversation up. But when you take a look at Wisconsin, right now, we carry a lot of Class 3 utilization. Right? As you look forward, that'll continue to be true. But we also have some Class 4 exposure, right? That's where that powder and butter conversation step into line. We got to be paying attention to both. And so in our software, we like to track all of this and take a look at all these utilizations and what that means in terms of your blended price and ultimately how that yields a mailbox price. These are the type of things that we like to watch. As we talk about the year in the past, you could basically go back and look at how things played out in terms of projections and, based on what's going on in terms of settlement, take a look at things and how they actually settled. This gives you a little bit of an idea of, we go through this averaging function every month. It gives you a little bit of an idea of how that plays out relative to some of your actual experience in terms of total deductions, PPD, and so forth. But you really need to kind of take a look at how you get paid. It's very important to this discussion. Right? If we're going to take a look at market risk and we're going to talk about where my exposure is, I better know how I'm getting paid for my milk so I know where the exposure lives. This is something it's a very helpful tool and something that we use as we talk to clients. So how do we manage risk? Here's one tool that's out there. I'm not going to spend a lot of time out of it. How many of you guys have gone to the FSA office and gotten signed up for this? Okay, for those of you who have not explored this, it's a very basic tool. You can get up to $9.50 of coverage on a margin that is put together and projected by the government. It is the old, feed formula that they've used relative to the all milk price that's put forward every single month. All right, as we look at that margin, they pay that out relative to your coverage. I will tell you that when it was MPP, this was not a very attractive program. But now that they've raised it to a $9.50 level of coverage, and they've taken the premium cost at the top tier from 47 cents down to 15, this is a layup. You want to sign up for this program. This is something that you want to have. Now, I will also say this. It's a really good program up to the first 5 million pounds. After that, it loses a little bit of its edge. It's a little bit more costly from there forward. So relative to the size of your operation, you're going to have to decide where to be. Our advice, though, is get that first 5 million pounds covered. After that, we're not that big of a fan as we go beyond the 5 million pounds. All right, here's where we're at, and this is as of, I think, Monday when I was in the office. First half averages, as we talk about Class 3, 1744, 1757 on the Class 4. Notice how that stacks up relative to history. You saw that in another slide. We're in like the 98th percentile. Prices are really strong relative to history. You have to go back to that magical 2014 year to find prices like this. There's some good stuff out here. Okay, here's how it stacks up to history. If I look at these prices and I say to myself, okay, what am I dealing with in the context of history? This is what you should be thinking about, right? We got a kind of a bell-shaped curve here a little bit, and basically, as you look at price, it loves to live between about 13 and a half bucks on the bottom side, over here to about 18 to 19 bucks on the top side. Where is the market right now in the second half of the year on a Class 3 basis? Anybody? 17. Who said that? Aha. I want to give him a hat. A hat for you, sir. Ultimately, we live in this box. This is normal. 3/4 of our ultimate results come in this range. Yet, we spend a ton of time talking about this, right? I can't tell you right now how many times I have to talk guys off the cliff because they're sitting here looking at these $17, $18 opportunities saying, we can't do anything with that because what if it goes to $24? What if it goes to $24? That'd be a great day, right? But knowing what we know, with the market standing right here, the other thing we have to recognize is that there's greater probability that it's going to go to $15 to $16. And what are you going to do about that? Just 45 days ago, we had December opportunities to book January milk at 19 bucks. Where's the price today? It's going to go off the board around 17 bucks. My, how things can change. The reality of our market is no one's going to be able to predict it for you. They can't. We can do a ton of homework on our end and we can come up with some pretty decent answers, but even them, they're not perfect. So the thing we have to always be asking ourselves is, with the opportunity we have on the table, what are we doing to make sure that it doesn't become less than it is? Right? We've got this tool, DMC, that's a great start, but I would tell you that if you do nothing and you walk through this year and you get to the end of it, you might look like this guy, having one of those oh crap moments. I missed it. So, what are some tools? Basically, there's several of them we're going to talk a little bit about. DRP, there's options, minimum price strategies. You've got the ability to book milk with your buyers. I'm going to tell you that at about 18, 19 bucks, you need to kind of change your mentality. Why? We just talked about this. Less than 15% of the opportunity lives above this point. So we start getting into this territory, we want to become more aggressive. We want to sell milk and defend it in some capacity. We're not there yet. So while we live on the other side of this column, we are looking more at option type of strategies. So as we talk about options, here's kind of how they play. And I know some of you understand this with great ease, but for those who don't, we're going to kind of have a real basic conversation. Basically, we're always afraid of this, right? The market falling. So what we do to defend that is buy a put option so that as the market falls, my put value increases and I have a cash offset to the loss that I'm experiencing in my milk check. It's really that simple. If the market falls, my put increases and I receive a return on that to offset what I'm not going to get paid in my milk check. It's real easy. Okay, we buy them at a certain level. If I bought a put right up here at this point and the market fell to here, I would make the difference. I'm going to spend some premium money to have that opportunity, and I'm going to move on with life. We'll see how things play out. Now that's the options. That's the traditional, put and call options as made available at the CME. Okay? We have a little bit of a new option out there. It's called dairy revenue protection. How many of you guys are familiar? Okay, lots of hands. This has gotten a lot of buzz in the course of the last couple of years. There are a lot of guys out there pushing this product. Basically, you get paid if the actual milk revenue experience on a quarterly basis is less than what you could put together in terms of a guarantee looking forward. So how do we talk about this? Well, real simple. If I take the CME value of milk today and I look at a particular quarter, Q2 is the most nearby quarter that I can cover right now. If I take that and I multiply that times the amount of pounds that I want to cover, and I multiply that times my coverage, I get my final revenue guarantee. Fast forward, we get through the quarter, Q2 is over with, I look at the actual prices, I take it times the same amount of production that I put in, then I multiply it times the yield adjustment factor, we'll talk about that in a second, and that gives me my actual milk revenue. So what is this yield factor? Well, I'm going to tell you it's the wild card in this entire policy. We have watched over the course of the last several quarters as territories in the country that would not have received a payment based on price have received a payment based on yield. Well, what the heck is yield? Well, here it's real simple. Basically, it's a measure of the state's production on a per cow basis. At the time you buy the policy, there is a projected number made available to you at that time as to what that yield will be. As we get to the end of the quarter and we've had all 3 milk production reports, we now know, based on what USDA told us, which, by the way, they can go back and change at a later time, just saying. But if we take a look at those 3 months, we add them up and we know what the total actual milk production per cow is, we can compare the two, and then if actual ends up being greater than expected, you end up with a yield factor that's greater than 1. Now, if I have a yield factor greater than 1 and I multiply that times my actual revenue, what happens to my actual revenue relative to the policy? It goes up, right? Anytime you take a number times a number greater than 1, it increases, right? So if I increase my actual milk revenue relative to my guarantee, what does it do to my indemnity? It lowers it, right? All right, we've got some great software that tracks how this yield plays out on a per state basis based on history. Basically, if I talk about this yield adjustment factor, it is just a wild card. We don't know where this thing is going to end up. You just have to realize that's part of the policy. All right? Indemnity lives over here. There's a way that you can essentially amplify this, and that's called the optional protection factor. They give you an opportunity to buy up from 1 to 1.5 on increments of 0.05. We are big advocates of this 1.5. We can have some more side conversations as to why and how we use that. But the reality is a policy bought without the 1.5, in my opinion, is a wasted policy. You just threw away one of the chief advantages in DRP. If you're going to go with a 1.0 because it's cheaper, well then let's talk about option strategies where I can get you closer to the market. The reality is that 1 is a waste of time. All right. We have our own portal that basically tracks all this where you can break things down and take a look at all of your different endorsements, see where they're at, what the protection is, how much you paid for it as we go forward, what the payout is going to be on that so you can project what kind of indemnity you're going to receive, and basically gives you a look at your entire situation, whether that's class or component-based endorsements. And I'm going to tell you right now, on this policy, and we sell a ton of this stuff, we are among the largest providers of this product in the country, and I'm going to tell you that as new people come to us, one of the biggest things that I see get messed up is using class versus components and knowing how, when, and why to do it. And there are certainly distinct times when it makes sense and when it does not. This is a big deal. All right. As we talk about breakdown, basically you can take a look on a component basis and see how that stacks up in terms of your class 3, class 4, and product by way of butter, cheese, and whey exposure. You stack that up here with butter, fat, and protein and be able to, talk very plainly about what the impact is on your farm, what kind of payout you're going to receive, where it came from, whether it's on a class 3 basis or a cheese or butter basis in your policy. Okay, financial picture. This is our last stuff, and then we'll move on. The reality of all of this is that we're trying to improve the bottom line, right? Why market, why manage risk if you have no idea that it's going to, impact the bottom line? The reality for us is that we'd like to track it. And basically, this is an instrument that we use. And we watch, what our hedge impacts are, both on the milk side and the feed side, so that we can project forward against our expenses and talk about real-time, forward-looking P&Ls. This is something you should be doing. This is something you should be watching. If you don't have a system for it, again, we can talk more. But I'm going to leave some time for questions because I know they want to keep us moving here. Uncle Sam gets a moment to speak here. We'll let him move on. All right, questions. Your time to have the floor. Yes, ma'am.
Okay, you started out with cost of production. What are most of your dairy clients, what's the range for their cost of production?
That is a very broad question because geography plays into that heavily. I can tell you that our Western clients versus our Midwestern clients have very distinctly different costs of production. We have clients, let's say in Colorado, that are producing milk for 14 and change. We have guys in the upper Midwest that'll tell you that their break-evens are somewhere in that 18 to 19, and I would say that we still can't answer that question for this year because we have no idea how the feed quality is coming out the backside, what the added feed expenses might be, et cetera, that could even be higher. But it does range often $4 to $5 from top to bottom. And honestly, Steve Bodart's in the back. Steve sees a lot of these things. He probably can answer that question better than I can. Great question, though. Exports. So exports, as we talked the month of November, were pretty solid. We believe that there's opportunities for us to continue to be a viable export player, but it's going to require that we come into alignment with world pricing. So the good news is we can clean up some inventory. The bad news is, to get that done, we're going to have to lower prices. The moment we start selling products at lower prices, which remember, our big domestic consumption period runs from late Q3 into the very first days of Q1. Mostly it's a Q4 consumption period. Domestically, that's what we prepare for. That's not to say people stop eating dairy the rest of the year, but we kind of maintain a status quo through the bulk of the year, and then we heighten all of our consumption in the fall. And so as that tapers off and we become more dependent on exports, those marginal volumes that are going to end up in a warehouse often are being pushed into the export market to keep the warehouse clearing itself and prevent old product from stacking up. So as we talk about the road ahead in these next several months, I do believe there's still some risk ahead of us because we ultimately do have this export price in terms of global pricing at a lower level than where we're at right now. So I think we're going to continue to export, and I think with this China deal behind us, maybe we get a little bit of an uptick from them. But powder markets are strong worldwide, right? There's some opportunity for us there, and as you could see, that's still our dominant product that we sell. There's some opportunity to play in the export space, but it comes with some compromises. Yes, sir.
How do you see Borden's closing and Dean's Food closing? How's that going to affect the whole dairy sector?
So the question was about Dean's and Borden's and some of that shutdown that'll be forthcoming. The reality is that it's going to definitely put some milk into some different places. Will it slow down production ultimately? We're not sure. We don't believe that it will. But at the same time, it's going to kind of reshuffle the deck, if you will, as to where milk ends up. And that's where, some of these expansions elsewhere in the country could start to absorb some of that. But let's face it, the fluid space has been in decline. And this is always a big, hot conversation in dairy circles, but I'm going to tell you that's nothing new. Fluid consumption, as we become an older society, has been in a downward trend for 50 years. So it's not like the space has been this large, robust consumer of milk. In fact, it's been in decline for quite some time. Other areas, though, are picking up the slack. And so in this particular example, I think you're going to see a lot of that happen really quick. There's going to be a lot of reshuffling and a lot of stuff moving towards different places and kind of hasten that move towards other products. Now, am I really down on the fluid space? No. I would tell you that as we came through the Farm Bill and we made a clearer picture for people to be able to hedge Class 1, that processors are going to be at a better space to be able to manage their risk and consequently put them in a spot where they can spend more money on R&D and start to put some different products out there. There are some real big success stories out there, right? We're all familiar with the Fairlife story. It's done remarkably well in a space that's been in decline. There's more of those opportunities, I believe, waiting for us, and if R&D goes into it, we might be able to find some solutions.
For the exports, back to that a little bit.
Yeah.
How hard do you look at currency relationships when you're tracking how that's going to play?
You're always watching that. Currency is a big play on every export deal you look at. On grains right now, for example, the Brazilian real is very weak. And as we talk about our ability to compete with Brazil in terms of going into the Chinese market, that has a big play. As we talk about what's happening with the euro on the dairy side relative to what's going on in the United States, that's always a conversation. And now that we seem to have maybe a clear path forward with Brexit, there is the chance that we could start to see a strengthening euro again, which bottom line starts to open up some doors for us because we go head to head with Europe all the time. So currency is always something to watch, and we watch it closely. Great questions. I thought I missed a hand somewhere. Any others? No. All right. Yeah, Chuck.
On the PPD, last month it was like $1 or so difference between, the fluid and cheese, so we get that taken out. Last month it was like 45, 55 cents, whatever. Now, if milk, let's say, is there any kind of limit on that ever? If milk class 3 is at 22, we could see $1.50, $2?
That's very possible, Chuck. The reality is there's no limit on PPD. And that ongoing balance as we talk about manufactured milk relative to fluid milk will continue to play out. And as long as the federal orders are what they are, you will continue to see that ebb and flow, and there are no limits whatsoever. These are great questions. How are we doing on time? Getting down there? Looky there, we got a few minutes left. Again, if you have a question you don't want to ask, by all means, ink it to the paper here, and we'll make sure we get back to you on that. Yes, sir.
How do you see upcoming presidential elections, pre-election and post-election, affect risk management strategies?
Great question. So the question was, how do the elections, pre and post, impact markets and hedging strategies? Well, there's always this ongoing theme in agricultural circles that election years are good years, right? There is some degree of truth to that. But at the same time, it doesn't pull all the risk off of the table. And so, I would tell you guys that as you go through this year, even though it's an election year and, we've got that hope that it's going to be better, that could be upended at any point. If there's ever been a time in my 25 years in this business where turbulence, volatility, uncertainty would define the moment, it's now, right? There's so much completely that's unknown that I don't think I would walk forward with any confidence that, that I should expect good prices. I would tell you right now, based on what we had talked about previously, kind of throw the election off of your radar and just talk plainly about price and how it plays out. And so, to me, what that means is we take an options-minded approach to managing risk. We put floors in, and that can be different for different people. Some are going to be more aggressive than others, but you start with an option strategy. You know, right now we've been using a lot of DRP as our baseline, building options around that and blending the two together. And you know, that's really the beauty of these tools, right? They're not standalone. They're not silver bullets. You don't just, you know, do one and you're good for the year. There's opportunities to use one as your base and then build on that with the others. And we've been doing a lot of that with DRP at the foundation and options above it. Because as markets ebb and flow, and as you get beyond, especially in the current quarter, you get beyond the sales closing date, and you can't go back and buy any more DRP coverage for the, you know, the current month or maybe the next two to follow, the option opportunities really start to stack in and really present some good opportunity. So I'm going to tell you right now, point blank, options, 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 and they come from a different, you know, several different angles.
What's your target on how much you're covering?
So Steve, the first half of the year, we're loaded up pretty heavy on the first half. And let's just talk plainly about that. If you look at any given calendar year, when do you guys normally have your worst milk checks? Jan through June or July through Dece? Jan to June, right? With that said, knowing what we know, going back to some of these other questions and some of the risk we have as we get more, you know, competitive in a global market, as we talk about just normal seasonality, normal stuff, a spring flush that's coming our way, all these different things, right? I want to be more aggressive in the period from now to June than I am in July through December. Now, we have great pricing in July through December, so does that mean we do zero? No. We've been, you know, moving in that 25 to 50% coverage range for guys that want to be a little bit more aggressive. Again, you can go in and buy DRP, build your base, and move on all of that, waiting for that time to be more aggressive in other tools, right? Options, futures, contracts with the plant, et cetera, et cetera. Great questions. All right, well, there's another group that has this room at 11 o'clock, and they're going to want to get started, so I'm going to turn it back over to them. Again, if you have a question that didn't get answered, please write it down. If you guys want to take a moment and fill these out. Also, if you care to have our weekly updates, by all means, write your information down. We'll make sure that you get that information as well. I'll be sticking around. If you want to pull me off to the side and ask some other questions, feel free. But thanks for having me out, and we'll see you guys around the conference.